Welcome back to the deep dive. Um, Today I actually want to start with a question that feels a bit like a wager.
Okay, I'm listening.
Can the greatest value investment of the 21st century be a company that is currently burning hundreds of millions of dollars to operate entirely within the realm of subatomic uncertainty?
That is quite the hook.
Right. Because usually when we talk about value investing, the old Buffett and Munger school of thought, we are talking about predictable cash flows.
Exactly. You want to see compounding happen in a nice straight line, tangible moats.
Yeah, companies selling things we easily understand, railroads, soft drinks, insurance. But today, we are looking at a source that forces us to throw that entire traditional playbook out the window. Or, well, rewrite it in quantum code.
We really are.
We're diving into a company that is unlocking computational power 36 quadrillion times greater than the world's leading supercomputers. But at the exact same time, it's facing a massive short seller attack
hmm
and allegations of accounting tricks, plus a burn rate that would frankly make a traditional banker faint.
It creates this fascinating paradox. We are looking at a company that is effectively existing in a state of financial superposition.
I love that term.
Yeah, to borrow from the physics they study, the company is simultaneously a potential monopoly on the future of all computing, a monopoly worth trillions, and at the very same moment, a cash-burning science project with serious allegations that could drive it to zero.
It's the ultimate binary bet. So let's introduce the subject. Today we are doing a deep dive into a deep research report on IonQ. The ticker is IonQ. And for everyone listening, context is everything here. We really need to anchor ourselves in time.
That's right.
The date of this analysis is specifically February 21st, 2026.
That date is crucial because this market moves incredibly fast. As of this specific Saturday, February 21st, 2026, IonQ is trading at $31.90 per share.
Which gives it a market cap of $11.84 billion.
Right. So everything we discussed today, the growth rates, the scandals, the tech breakthroughs, is frozen in this exact moment in time.
Okay, let's unpack this. We have a ton of ground to cover, from subatomic physics to Wall Street short squeezes.
Let's get started.
Part 1, Chapters 1 to 3, Business, Management, and Financials.
Chapter 1, Business Understanding.
So the first thing we need to wrap our heads around is what IonQ actually is. Because I think there's a misconception out there that they just sell fancy computers.
Yeah, like Dell or HP, but for the 22nd century.
Exactly. But that's not it, right?
No, it's a common misconception, but that's not the model at all. IonQ is what we call a pure-play quantum hardware and software provider. But their business model isn't about shipping a giant crate with a quantum computer inside to your office.
Thank goodness, because I wouldn't know where to put it.
Right. It's really a quantum as a service model, QoS.
QoS. That sounds great on a pitch deck, but practically speaking, does that mean they are just a cloud provider?
Think of it more like they are the engine room for the cloud. They aren't selling the boxes. They're selling access to the brains inside the boxes via the cloud. They have these massive partnerships with the big three: Amazon Web Services, Google Cloud, and Microsoft Azure.
So if you're a client, how does that work?
Well, say you are a pharmaceutical company trying to simulate a complex molecule. Or maybe a bank trying to run a risk model that would take a classical supercomputer 10 years to solve.
Okay.
You log in, you pay IonQ, and you run that specific job on their quantum processing units remotely. You never actually touch the hardware.
So they are basically renting out genius-level intellect by the hour.
Precisely.
Yep.
And their revenue comes from those commercial partnerships, but also from highly specialized academic research and, very significantly, government and defense contracts.
Ah, the government contracts.
Yeah, that last part is going to be incredibly important when we discuss the controversies a bit later. It is the bedrock of their current cash flow, but as we'll see, it's a potentially shaky foundation.
We will definitely get to the drama there, but first I want to challenge you on the tech stack. The report mentions IonQ does something fundamentally different than the big guys like Google or IBM. They use trapped ions. They do.
Now, usually when a startup goes against Google's standard, the startup gets crushed. Why is this different?
It comes down to the fundamental physics of the machines.
Yeah.
If you look at competitors like Google or IBM, they are largely using superconducting circuits.
Which means they need to be cold, like really cold.
Colder than deep space.
Yeah.
We are talking massive, highly complex cryogenic refrigerators. It's incredibly heavy infrastructure. You basically have to build a specialized building around the computer just to keep it cold enough to function without interference.
And IonQ, what's their trick?
IonQ uses a trapped ion architecture. They use precision lasers to manipulate individual atomic ions. And the real kicker here, they do this at room temperature.
Room temperature sounds great on paper, but I've heard critics argue that trapped ions are actually way harder to scale.
Because you can't just print them on a silicon wafer.
Exactly, like you can with superconducting circuits. Does the room temperature benefit actually outweigh the manufacturing nightmare of using lasers? That is the completely valid counterargument. You are essentially trading one massive problem for another. Sure, you lose the giant dilution refrigerator, but you trade it for an optical labyrinth.
An optical labyrinth.
Yeah, you have to keep these specific ions perfectly still using electromagnetic fields, all while hitting them with lasers that have to be precise down to the nanometer. It's like trying to hold a beach ball in the air with fire hoses while standing in a hurricane.
That is a terrifying visual for an engineer.
It really is. But if you can pull it off, and IonQ's data suggests they are indeed pulling it off, it offers massive benefits: stability, error reduction, and eventual miniaturization. You don't need a building-sized freezer.
Makes sense.
And this specific tech stack led to a massive breakthrough recently. The report highlights that in late 2025, they reached AQ64. That stands for 64 algorithmic qubits. And they did it 3 months ahead of schedule.
AQ64. Now, to the average person, 64 sounds like a tiny number. My laptop has gigabytes of RAM. Why is 64 a big deal here?
Because in the quantum world, power scales exponentially, not linearly. Reaching AQ64 unlocked a computational space that is exponentially larger than what even the most powerful supercomputers on Earth can handle.
So it's a tipping point.
Exactly.
Hey.
It's the threshold where you stop simulating quantum physics and start actually doing it in a way classical computers simply cannot touch. We are talking about 36 quadrillion times the computational space of a classical supercomputer.
That is mind-bending. But they aren't just staying in the lab, right? Because the report goes heavily into this David versus Goliath strategy, where they're actively acquiring other companies.
Yes.
And this is where I get a bit skeptical. Usually when a deep tech company starts buying other companies, it means they've run out of ideas for their own product.
Or it means they're realizing that relying on other people's supply chains is a fatal weakness. This is the strategic shift that happened in 2025 and early 2026.
Moving from research to empire building.
Exactly. They aren't trying to compete with NVIDIA on classical chips. In fact, they are partnering with them on the CDAQ platform. But they are buying up the physical supply chain. The report details a massive acquisition spree, specifically the $1.8 billion acquisition of SkyWater technology.
SkyWater, that's a semiconductor foundry, right?
It is.
Why does a quantum company need a foundry? Foundries are notoriously capital intensive. Intel is struggling with them. TSMC spends billions. Why does a startup think they can run one?
Vertical integration. They want to own the whole stack. By buying SkyWater, they can manufacture their own chips domestically. It's a move to completely domesticate their supply chain. They also bought a company called Skyloom, which specializes in satellite networking.
Wait, satellites. Are they trying to go to space now?
Orbit, yes. They are building a future where quantum computers communicate with each other via satellite to create a massive entangled network.
Okay, that's ambitious.
Very. They want to own the silicon, the quantum processor, and the network that connects them. It's an incredibly aggressive play to control the entire ecosystem. But you're completely right to be skeptical. Managing a foundry introduces massive operational risk.
So the value proposition here is really twofold. For the client, it's quantum advantage, solving problems like drug discovery or logistics that are impossible today. But for the investor?
For the investor, it's the race to quantum error correction. IonQ claims a world record 99.99% two-qubit gate fidelity. If they can maintain that accuracy while scaling up, they win the race.
But the manufacturing risk of owning SkyWater is a massive anchor if they misstep.
Chapter 2. Management evaluation.
So we have this incredible technology. We have the lasers, the room temperature advantage. But a ship is only as good as its captain. And right as they hit their technical peak, they sailed straight into a storm.
A massive storm.
And that storm has a name. Wolfpack Research. But before we get to the antagonist of the story, let's meet the person running the ship, who is at the helm.
The CEO is Niccolo De Masi. He is certainly not lacking in ambition or confidence. De Masi has been the driving force behind this entire transition from a university science lab to a publicly traded giant.
He took them public, right?
He steered them through the SPAC process, he pushed for the AQ64 milestone, and he is the primary architect of this aggressive M&A strategy. He essentially wants IonQ to be the Cisco, the Intel, and the Google of the quantum era, all rolled into one.
But it haven't been smooth sailing. In early February 2026, just a few weeks before this report's date, they hit a major iceberg, Wolfpack Research.
Right. Wolfpack Research is a short-selling firm. That means they make money when a stock goes down.
Right.
They released a scathing report accusing IonQ of some pretty serious things.
And usually short reports can just be noise, but this one seemed to really stick. What was the core accusation here?
The core accusation was specifically about the quality of their revenue. Wolfpack alleged that 86% of IonQ's revenue from the Pentagon between 2022 and 2024 didn't actually come from recurring commercial demand.
Where did it come from?
They claim it came from political backdoor earmarks.
Earmarks. That sounds like temporary money.
Yeah.
Can you explain the mechanics of that for us? Because we need to be clear. We aren't taking a political stance here, just looking at the accounting claim. Why is an earmark worse than regular revenue?
Sure. Think of it like a grant versus a subscription. A grant or an earmark is a one-time injection of cash to build a specific thing. Once it's built, the money stops.
Okay.
A subscription is recurring. It grows organically. Wolfpack is saying IonQ essentially dressed up grant money, which was tied to specific legislators, to look like subscription money or recurring revenue.
Ah.
They argue this made their growth curve look exponential rather than sporadic.
The implication being that once the political winds shift, say, after the 2024 election, that money just vanishes.
Exactly. The claim is that this revenue was tied to specific allocations that evaporated after the 2024 election. The implication is severe. Wolfpack is arguing that management used this recent acquisition spree-buying companies like Skywater to basically buy revenue.
To mask the fact that their organic growth had fallen off a cliff.
That is the accusation, yes.
Fake it till you make it, but with billions of dollars. How did management respond to this?
They categorically denied it. They argued that the acquisitions are strictly about supply chain security, which is a legitimate concern in deep tech, and that their government relationships are based entirely on merit. But the damage to market trust was very real.
And speaking of trust, looking at the insider trading data in the report, it doesn't exactly calm the nerves.
No, it doesn't at all. This is often called the trust factor in investing. Coinciding with this Wolfpack report, we saw a significant amount of insider selling.
Who was selling?
The chief revenue officer, Rima Alameddine, sold about $5.5 million in stock.
Wow.
The CFO, Thomas Kramer, sold $2.7 million, and CEO Demasi sold around $715,000.
So while they're telling the public that everything is great and they are buying foundries, they are personally cashing out millions. That feels inconsistent.
It raises a huge red flag. Now, executives sell stock for many completely normal reasons. Buying a house, paying taxes, simple diversification.
Sure.
But when you have the CFO and the CRO selling millions right before or during a crisis of confidence, it forces you to ask a tough question. Do they really believe in their own moonshot? Or are they taking chips off the table because they know that earmark money is gone?
It's the classic principal agent problem. Now let's talk about how they are spending the company's money. The report calls it a swing for the fences strategy.
It is. They are absolutely not paying dividends. They are not buying back shares. In fact, they are doing the exact opposite.
Diluting shareholders.
Heavily. They raised $2 billion in equity in late 2025. They are printing shares to raise cash to buy these other companies.
And the metric that really stands out to me here is the ROIC, return on invested capital. The report listed at negative 41%.
That is a brutal number. It means for every dollar they invest, they are currently destroying value. In a mature company, like a retailer or a car manufacturer, a negative 41% ROIC would be an absolute death sentence.
But for deep tech.
The argument is that this is the cost of doing business. You have to build the lab before you can sell the science. But for a traditional value investor, seeing that much capital destruction is terrifying. Chapter 3. Financial health.
Let's dig deeper into those hard numbers. We talked about the strategy, but what does the bank account actually look like? The top line, the revenue, seems explosive at first glance.
It is explosive. If you look at the chart, revenue went from about $2 million in 2021 to around $110 million in 2025.
That's massive.
It's a growth rate of over 100% year over year. By any standard, that is hypergrowth.
But there is a caveat, right?
Yeah.
We just talked about them buying revenue.
The caveat is organic versus inorganic growth. A lot of that top-line growth in late 2025 didn't come from selling more quantum compute time. It came from acquiring companies that already had revenue and simply adding it to IonQ's books.
So the top line looks great, but it's partly engineered.
It's accounting glue, not necessarily organic customer demand.
And then we look at the bottom line. And brutal might be an understatement here.
It's ugly. In Q3 of 2025 alone, their net loss was $1.1 billion.
Billion with a B.
Yes, with a B. Now, a large chunk of that was one-time costs associated with these massive acquisitions we talked about. But even if you strip that out, the EBITDA margin is negative 492%.
That's wild.
They're spending almost $5 for every $1 they bring in.
How is that even remotely sustainable?
It's only sustainable if you have a massive savings account. And this leads us to the balance sheet section of the report, which is really the one shining light in the financial data. This is the good news section.
War chest.
Exactly. IonQ has zero long-term debt. And thanks to that equity offering we mentioned, their pro forma cash position is $3.5 billion.
Wait, 3.5 billion. That sounds amazing, but if their burn rate is over $1 billion a year, like you just said, that's not really a war chest. That's a 3-year runway.
That is the crucial insight here.
It's a pretty short fuse for a company trying to invent new physics.
$3.5 billion is a lot of money to you and me. But when you are running a semiconductor foundry like Skywater, you can burn through that in 36 months easily. It's a lifeline, yes, but it is not an infinite runway.
Right.
It allows them to survive the valley of death and ignore profitability for a few more years while they build the tech. But the clock is absolutely ticking and louder than most people realize.
So how do you even value a company like this? You can't use a standard PE ratio because they don't have earnings.
You have to get creative and admittedly slightly speculative. We look at relative valuation first. They are currently trading at roughly 37 times their projected 2027 sales.
37 times sales 2 years from now? Is that expensive?
Historically, it's astronomical. Most healthy companies trade at 2 to 5 times sales. But compared to their peer, D-Wave, which is trading at 89 times projected sales, IonQ actually looks cheap.
It's all relative in a bubble.
Exactly.
The report mentions an educational DCF, a discounted cash flow model. Usually you use that to find the intrinsic value. But here they did a reverse DCF.
Right. Because of the current cash flow is deeply negative, a normal DCF just says the company is worth nothing. So the analysts worked backward. They asked, to justify the current $31.90 stock price, what does IonQ actually need to do?
And what's the answer?
To mathematically justify the price today, IonQ needs to grow its revenue at 43% annually for 21 years straight.
21 years of 43% growth. Has any company ever done that?
Maybe Amazon or Google in their absolute prime. It is an incredibly high bar. It tells us that the stock price isn't based on today's math at all. It's a wager. A bet that IonQ will literally be the Google of 2040.
And if they miss that growth target, even slightly.
The stock is vastly overpriced today.
Part 2, chapters 4 to 7, market sentiment, ownership, risk, and final conclusion.
Chapter 4, market sentiment.
So we have looked deeply at the company itself, but now let's look at the market around the company. Because reading this report, there seems to be a massive disconnect between what Wall Street analysts think and what the technical charts are showing.
It's a total battleground. On one side, you have the professional Wall Street analysts. The consensus rating right now is a moderate buy. Their average price target is $75.91.
Wait, the stock is at $31.90? So the pros think it's going to more than double.
Easily. Some even have targets as high as $100. They are looking at the underlying technology, the AQ64 milestone, and that monopoly potential we discussed.
They're buying the dream.
They are looking at the total addressable market and seeing trillions.
But then you look at the media and the retail traders, and it's a completely different story.
Completely polarized. The tech press loves the science. They write about the lasers and the qubits. But the financial press is obsessed with the Wolfpack fraud allegations and the class action lawsuits coming from firms like Scott plus Scott.
You have the scientists cheering and the forensic accountants screaming.
Precisely.
And that polarization leads us directly to the short squeeze setup. The report says short interest is extremely high right now.
Dangerously high. About 23% of the float, meaning the shares actually available for trading, is sold short. That means nearly a quarter of the available shares have been borrowed and sold by people betting the stock will crash.
And the days to cover metric is over 6 days. Now, rather than just defining that, tell me what that actually means in this specific 2026 market environment.
A days to cover ratio over 6 in this volatility environment is a powder keg. Days to cover basically measures the short seller's pain threshold.
Okay.
If IonQ announces just one piece of really good news, say a massive new contract or another tech breakthrough, all those short sellers might panic and rush to the exit at the exact same time.
They have to buy the stock back to close their position.
Right, but because it would take 6 full days of normal trading volume for them to buy back all those shares, the price would skyrocket instantly. It drives the price vertical.
A short squeeze.
Exactly. Any positive catalyst from the Department of Defense and the squeeze could rip faces off before the shorts can even locate shares to buy.
So while the stock looks weak, it's sitting on a pile of dynamite. But right now, looking at the technical analysis, the fuse isn't lit yet, is it?
No, technically, it's what traders call a falling knife. The stock is trading about 28% below its 50-day moving average and 32% below its 200-day average.
So trend traders see that and run away.
They say stay away. But value investors might look at that exact same chart, see the massive price drop, and say oversold. Chapter 5, Ownership Structure.
Let's talk about who is actually holding the bag here. We know the insiders are selling, which we covered, the CFO and CRO cashing out millions. But who is on the other side of those trades? Who is buying?
The giants, the
Yeah.
whales. We are talking about Vanguard and BlackRock. Vanguard owns about 9.8% of the company. BlackRock owns about 8.5%.
And are they just holding steady?
No, they are accumulating. BlackRock recently increased their stake by 33%. They are aggressively buying the dip.
Let's pause on that for a second. You have the CEO and CFO selling their own stock. You have a short seller screaming fraud. And yet BlackRock, the largest asset manager in the world, is backing up the truck and buying more.
It is a massive divergence.
Do they know something Wolfpack doesn't?
It suggests that the institutional algorithms or the long-term fund managers there see the Wolfpack report as just short-term noise. They are looking at the 10-year horizon. They see a company with $3.5 billion cash and world-leading tech, and they think $31 is a bargain.
Or they are just index buying?
That happens, but usually a 33% increase in a position suggests active conviction.
But there is a huge risk in this ownership concentration.
A severe liquidity risk. The top 3 institutions plus the top 5 insiders control nearly 50% of the entire company.
Half the company's in just a few hands.
Exactly. If BlackRock decides tomorrow that they made a mistake and start selling, there simply isn't enough retail liquidity to absorb millions of shares. The stock crashes.
And conversely.
If the insiders stop selling, the supply of shares dries up completely. It's a very tight market. You are effectively swimming in a pool with 3 blue whales. If just one of them turns around quickly, you get crushed. Chapter 6, Risk Assessment.
We always have to look at the downsides thoroughly. The report uses a standard SWOT analysis. Strengths, weaknesses, opportunities, threats. Let's walk through the blue ocean opportunity first, the upside.
The opportunity is the sheer size of the prize. The total market for quantum computing is expected to hit $16.3 billion by 2030. But it's not just about selling isolated computers, it's about convergence.
Convergence with AI. I feel like AI is the buzzword of the decade. But is there real substance there for IonQ?
Yes. The report heavily highlights their integration with NVIDIA's CUDA-Q platform. Imagine using quantum computers to accelerate generative AI models, or to simulate proteins for drug discovery instantly.
It changes everything.
If IonQ can become the foundational hardware layer for the next phase of the AI revolution, the potential is essentially limitless. And with Skyloom, they're looking at linking these quantum computers via satellite to scale their power exponentially across the globe.
That's the dream scenario. But we have to talk about the external threats. The macro environment isn't really helping them right now. Specifically, geopolitics and tariffs. Remember, it's early 2026. The world is getting much more protectionist.
This is a major, major headwind. The report specifically cites the 2025 U.S. tariffs. We are seeing a 10% baseline tariff globally and a 34% tariff specifically on China.
How does that hurt a U.S.-based quantum company, though? Don't they want U.S. manufacturing anyway?
They do, but the current supply chain is deeply global. IonQ relies heavily on rare earth materials, highly specialized lasers, and advanced optics that often come directly from China or Japan.
I see.
A 34% tariff on those core materials drives up their cash burn rate significantly. It makes R&D much more expensive and slows down their timeline.
Which brings us right back to the Skywater acquisition.
Precisely. Why pay $1.8 billion for a U.S. foundry? To build a wall around themselves. They are trying to immunize themselves against the trade war by domesticating the supply chain before the tariffs bleed them dry. It's a defensive move just as much as an offensive one.
And then there's the interest rate threat.
High interest rates are poison for long-duration assets like IonQ. Their big profits are promised in the 2030s. When interest rates are high today, money in the future is mathematically worth less right now.
It suppresses the valuation.
Exactly. In this specific market climate where investors can get 5% virtually risk-free, asking them to hold a volatile stock for 10 years for a payoff is a very hard sell.
And finally, the competition threat. We mentioned Google and IBM earlier.
The looming existential threat is that Google or IBM solves quantum error correction using a completely different technology like superconducting qubits before IonQ gets there with trapped ions.
The Betamax problem.
Exactly. If that happens, IonQ's tech becomes Betamax. It might be great tech, superior picture quality, so to speak, but it's the wrong standard. And in hardware tech, the wrong standard goes to zero. Chapter 7. Conclusion.
So what does this all mean for the listener? We've looked at the quantum physics, the fraud allegations, the billions in cash, and the massive macroeconomic risk. Let's synthesize this. Give me the ultimate bull case.
The bull case is simple. IonQ is building the physical infrastructure of the future. They have the money. $3.5 billion is a massive war chest that protects them from near-term bankruptcy.
They have the tech.
Right. AQ64 is real, and the trapped ion approach at room temperature is working. And they have the partners. BlackRock is buying, NVIDIA is partnering. If they win this race, they are a true monopoly worth trillions. It is a generational stock.
And the bear case.
The bear case is that the current valuation is defying gravity. Paying 37 times sales for a company with negative 492% margins is reckless. The Wolfpack allegations regarding fake revenue and political earmarks are very serious and haven't been fully resolved.
Plus the insiders selling.
Exactly. The people who know the company best are cashing out while retail investors hold the risk. Plus, those tariffs and the foundry costs could drain their war chest much faster than expected.
And looking at the valuation recap we discussed, the math suggests the current price is purely speculative.
Intrinsic value calculations are currently negative. There is no fundamental floor based on cash flow. The stock price is supported entirely by belief in the future.
So the final outlook. The stock is sitting at $31.90. Analysts say $75.91.
It is the ultimate binary bet. I really don't think the stock stays at $30. It will likely either go to zero if the fraud allegations stick or the tech fails to scale, or it goes to the moon if they crack error correction first. It's a high-conviction play for anyone who truly believes in the physics of trapped ions.
It reminds me of the superposition we started the show with. The cat is both dead and alive. The company is both a fraud and a trillion-dollar monopoly. And until we open the box, until we see the next few years play out, we simply won't know which state is real.
And that is exactly what makes it such a fascinating deep dive. It forces you to choose what you believe in. The skepticism of the short sellers, or the optimism of the quantum physicists.
A perfect place to leave it. For those of you listening, this is definitely one to watch closely. The volatility is going to be wild.
Absolutely. Buckle up.
Thanks for joining us on this deep dive. We'll catch you on the next one.
This analysis was generated by AI for educational purposes and should not be considered financial advice. Please do your own research before making investment decisions.